Have you ever looked at a stock chart and just felt lost? Like you were staring at some kind of alien language? Well, guess what? You kind of were. You see, every single chart is telling a story, a dramatic story about fear, greed, and conflict. So today, we're going to learn how to decode that secret language together.
Think about it this way. A company's earnings report, that tells you what happened 3 months ago. It's history. A chart, though, a chart tells you what investors are feeling right this second. It is literally the real-time heartbeat of market psychology. And learning to read it, that's a superpower. So let's reframe how we look at this. We're not just staring at some lines and bars on a screen. No way. We are watching an epic, non-stop battle between the buyers, the bulls, and the sellers, who are the bears. Every single tick up or down is one side gaining an edge. And the story really begins right here with this one shape. A single candlestick isn't just a data point. It's like a miniature chapter in the story. It tells you who threw the first punch at the open, who was winning the fight midday, and who ultimately stood victorious at the close. It's basically a battle report in a box. All right, so I want you to think of yourself as a detective, a pattern detective. These candlestick shapes, they're your first clues. They give you these little hints about what might happen next. But, and this is a big but, here's the twist. These clues, they can be misleading. They can flat out lie to you. The real secret is knowing when you can trust them. Okay, take a look at these two patterns. See them? They are identical. Same exact shape. Yet one of them, the hammer, signals a potential bottom. You know, like we saw an HDFC Bank during the big COVID crash. The other, the hanging man, it warns of a potential top, kind of like one that popped up on Infosys right before a correction. This proves the single most important point. A pattern means absolutely nothing without context. All right, detective, challenge number 1 for you. You spot this exact shape after a stock has had a massive 25% run-up, and it's sitting at a new high. What's the call? Is this a good sign or a bad sign? You got it. If you said bearish, you are absolutely right. That's a hanging man. It's the context, that big rally hitting a potential ceiling that flips its meaning completely. Okay, now let's level up to a more complex clue, the morning star. You gotta see this one as a 3-act play. Act 1, the sellers are totally in charge, pushing the price down hard. Act 2, the fighting grinds to a halt. Nobody knows who's gonna win. Pure indecision. And then the finale. Act 3, the bulls come roaring back and seize control. It's the classic story of a reversal. Now here's what's wild. On its own, a Morningstar pattern is, well, it's barely better than a coin toss. It works maybe 45% of the time. But add one secret ingredient, high volume on that final bullish candle, and suddenly the success rate skyrockets to 70%. That one little piece of data changes the entire game. And it really makes you wonder, why do these patterns that look so perfect on paper just fail so often? Well, truth is, there are a bunch of reasons. You might be ignoring the bigger trend, or get caught in a trap set by algorithms, or maybe some unexpected news just blows everything up. But there is one reason that stands head and shoulders above all the others. Would you look at this? It's not even close. A massive 70% of all candlestick pattern failures come down to one single thing, a volume mismatch. It's when the price is telling you one story, but the volume, the amount of participation, is telling you a completely different and, frankly, a much more honest story. And this right here brings us to the absolute core secret of this entire explainer, volume. You need to think of volume as the market's built-in truth detector. It's the one tool that professionals use to figure out if a price pattern is a real signal or if it's just meaningless noise. So what is volume, really? It's just the number of shares being traded. But what it really measures is conviction, passion. See, high volume means the big players are involved, the institutions, the hedge funds, what we call the smart money. Volume is the fuel in the market's engine. Without it, the car ain't going anywhere. This little grid right here, this is your Rosetta Stone for understanding volume. The whole principle is super simple. High volume confirms what the price is doing, while low volume makes you question it. Just look at the difference. Price is rising on high volume. That's strong, that's healthy. But price rising on low volume? Whoa. That is a major red flag that the move just doesn't have any real muscle behind it. And if you need more proof, here's the cold, hard data. A price breakout that happens on low volume, it fails 80% of the time. It's a classic trap. But when that same breakout happens on high volume, we're talking more than double the average, the success rate shoots up to over 80%. See? Volume is the ultimate confirmation. So the single most important takeaway is this. If a price move is not backed by a surge in volume, it means there's no institutional conviction. The big money isn't buying it, it's not a real signal, it's just random market noise. And your job is to learn to ignore the noise and listen for the signal. Okay, so this is all great, but how do we actually put it all together into a system? How do we go from being a confused chart gazer to a sharp analyst? Simple. We use a checklist. And here it is, a dead simple 5-point checklist to put all these ideas into action. Now, this isn't just a list of nice-to-haves. This is a professional framework. It forces you to go beyond just spotting a cool-looking pattern. It makes you systematically verify the context, confirm the volume, and manage your risk before you even think about putting money on the line.
And you know what? This is the one thing that separates the amateurs from the pros. Discipline. If even one of these 5 points fails the test, you either skip the trade completely or you drastically cut down your risk. No exceptions. No, well, maybe this time. The process is your edge. So at the end of the day, every single chart is telling a story of human emotion and institutional money flow. The patterns are like the words, sure, but volume is the tone of voice. It's what tells you if they're serious. The only question left is, now that you know the language, are you actually ready to listen?